3 important ways the stock market impacts the real estate industry. If you want to know everything from living, dining, sleeping, buying, and selling in the Detroit Metro, hit subscribe and tap the bell because I have new videos coming out weekly. And I absolutely love when people call me, text me, email me, because they're thinking about buying or selling in the Detroit Metro. So if you have any plans to buy or sell in the Detroit Metro, text me, email me, or even send the pigeon carrier because I've got your back. The performance of a stock market has a significant impact on the real estate industry. Wall Street swings can determine lending rates, home sales, and other industry trends. The stock market's research can even be felt in major metropolitan areas and smaller regional corners of the world. And starting with number 1, we're going to talk about credit. Real estate investing relies heavily on credit, and transactions are simply too large for average individuals just to pay cash. Credit makes it possible for them to participate in the real estate industry, and Americans take on debt so they can afford larger purchases. Nearly every transaction that takes place in the housing market is subject to interest rates. And interest rates depend partly on the health of the stock market. And in the event of a downturn, for example, uncertainty becomes more prevalent. When people question the trajectory of the stock market, they evaluate risk. And banks assess risk and adjust their interest rates accordingly. In other words, banks may increase interest rates to compensate for market uncertainty. It's their way of protecting themselves, and as a result, borrowing money may cost consumers more today than it did yesterday. But on the other hand, banks are more inclined to reduce rates in the face of a healthy market outlook, and confidence in the stock market enables institutional lenders to reduce their rates behind encouraging trends. The lower the risk, the more comfortable banks are with lending at lower rates. And real estate investors benefit from lower interest rates as more people can afford purchasing a home. Even if it means saving a few $100s a year, lower interest rates like the current ones can spur people to buy homes that they might otherwise have hesitated on. Even the threat of increasing interest rates may encourage consumers to push forward on a purchase. It could be some time before we see today's interest rates. Number 2, talking about consumer behavior. Stock market performance influences consumer behavior, and when the stock market is going well, consumer confidence rises and individuals are more likely to make real estate investments. When the market is down, consumers are less likely to spend, and the less inclined people are to spend on money, the less likely real estate investors may be to sell properties. People often base their spending habits on the success of their portfolios, and when portfolios are down, individuals are more likely to err on the side of caution and save their money for a rainy day. And number 3, competition. Declining confidence in the stock market changes the nature of competition. There may be fewer suitors for the same property. Banks may compete harder for your business, and that can work to a buyer's advantage. Of course, a more favorable market may do the reverse. And if you have any questions, don't hesitate to reach out because I've got your back.